Good morning, everybody. We'll get started here in less than 2 minutes. Letting everybody get in to the call here. Good morning, everybody. We'll get started here about a minute and a half. Good morning, everybody. We'll get started here in about 1 minute. Good morning, everybody. We'll get started here in about 30 seconds. All right, we'll get started. So hopefully you had a wonderful late fall weekend. You're getting prepped for the holiday season coming up very quick here. So it's kind of a fun call. It's one of my favorite topics in Soaring to Avoid Checklist, but a couple of things before that. You can actually take this quiz for free, guys. 16 personalities quiz. I would highly recommend, since it's free, I would highly recommend you take it and any of your staff take it, because knowing, for the staff to know you and how you communicate and your personality, and you to know your staff's personality and how you communicate is a great way to increase the efficiency and especially communication efficiency of your office. And that's always going to be a good thing for your office, and it's going to be a good thing for your relationship with your client. So basically, if you just go to www.16personalities.com, and if you just go there, it'll send you to the free. You don't need to backslash here, because it'll actually send you to that free quiz. But if you want to go directly there, free-personality-test. So it's a fantastic tool for you to use, and I'm always a big fan of free tools that make us better at better people and better business people. So why learn about personality types? Gaining insight into the types of team members you work with help you identify and leverage your team's strengths and address weaknesses or gaps. Ensure you're deploying team members to fit their natural preference where you're possible best, and help identify areas of similarities and differences so you can be more informed when communicating with each other, coming to and agreeing on decisions, developing processes, deploying members of the team, and creating development plans. So, I mean, this would have been a great thing. It took Missy and I about 5 years to finally figure out each other's personality types and how we communicate. So we got into, I mean, I would say she was my work wife, and she has her work husband, and we would get into some verbal altercations that were quite loud and boisterous, where we wouldn't talk to each other for 4 or 5 hours afterwards. So, but if she'd known why I was doing or saying the things I did, and I knew the reason she was saying and doing the things she did, it would have eliminated all that, because she could have said, oh, I see, it's Mike being Mike, or I could have said it's Missy being Missy, instead of taking it as an affront. Because as personalities, we think everybody should be our personality. We look at the world through our eyes and our personality, and that's not the way the world works. Actually, there's 16 different personalities, and knowing why that person in front of you is doing, I mean, I'd love for clients to take this, but you can't really have them take this. But at least with your workmates, it makes total sense, because then you'll understand why they're doing what they're doing and not take it personally. So it's a free tool. Why not use it? www.16personalities.com. This was sent to me a while ago by Millen, so thanks, Millen. And it's talking about how persistent should you be with prospects. Research says that affluent prospects classify the financial advisor sales process. How do you know when you're being too salesy? How would you and they ask people, how would you classify your financial advisor sales process? 7.3% too persistent, 22% not persistent enough, 69% just right. Well, this is kind of a stupid graph here. Why is this a stupid graph? Because they ended up becoming clients. Of course, most people thought you were persistent enough. It'd be better, and again, you can't do this, and there's no way research could do this, is to find out why the people who did not work with you, what did they think? Did you were too persistent, not persistent enough? Because obviously the people who you work with are going to say you're persistent enough because they end up working with you. But there are some good takeaways here, which is 3 components of being just persistent enough. Number 1, ask questions. Well, that's the whole 5Q system, right? It's the whole motivational techniques. Most advisors enter various situations ready to find the next business opportunity. They're basically ready to sell. Close soon, close often, right? Nope. They want to talk about themselves and their business. Not so subtle approach to uncovering new opportunities ends up activating people's sales antenna. So guys, when you go in and talking about all the how great you are and how great you treat your clients and how much you care about your clients, blah 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 blah, in today's world, their sales antennas go straight up. Instead, make the conversation about them, not you, and that's what we do, right? That's exactly what we do. Ask general rapport building questions about the person with whom you're speaking. Ask about their family, work, personal interests. I'm not a big fan of this, though. I'm not a big fan of this because when you start doing this, what do you start to smell like? You start asking about their family, their work, what do you do for fun? And yes, Tom, you sound like a salesman. So, the analogy I give is this: is when first of all, are our finances personal? When it comes to people, you start asking about their money, about their finances, about their spending habits. Is that personal? Yes, Tom. It's very personal. So when people are asking, strange people who you've just met start asking you personal questions, does that make you more or less nervous, more or less uncomfortable? It makes you more uncomfortable. So the analogy I give is this: is if I'm in the doctor's office and I've got nothing on but the gown that's wide open in the back, and I'm nervous, I'm uncomfortable, I'm basically naked in front of this doctor, and he starts asking about my family and my work and my personal interests. Do I want to talk about those things when I'm uncomfortable? No, I'm in his office and it's like, get to the point. Be nice, be courteous, be friendly, but let's get this over with. Let's get to the point. I don't like having my bare ass hanging out in front of you talking about these things. That's the same thing when they come into your office. They didn't come in here to talk about their personal situation. And again, this is old school rapport building. Hey, you went to the University of Minnesota, sir? Hi. Oh, blah, blah, blah. Oh, your kid went to, is a paramedic. So is mine. I mean, now that's when you start doing that, they know immediately you're not doing that because you're truly interested in them. And I don't care if you are truly interested in them. That's not how they're viewing it. They're viewing it as this guy is just trying to be nice to get into my wallet. And again, as salespeople, we're friendlier than most people. So when people do it to us, sometimes we're thinking, oh, that's friendly, that's nice. That's the way we react to the world. To go back to personality, that's the way we react to the world. So we think, hey, that's kind of cool that they're interested in me. Most people are not salespeople. Guys, are most people in the world salespeople? Do most people in the world like to knock on doors, like to meet strange people, like to get in front of groups of strangers and promote a product? Is that where most people are, or is that a very, very specific personality type? They don't like that at all, Mark, do they? So we sometimes make the mistake of thinking we don't mind people doing that. So obviously they don't mind us doing it to them. That's not the case. In today's world of boomers and Gen X and Gen Z, they're sophisticated. They're going to snip it out. So ask questions that are, but let open-ended questions so they can tell you what they want to talk about. Don't start asking personal questions. When it flows with the conversation, you can suddenly begin to ask questions that have a small dose of business implication. Are you planning to play golf in retirement? You get blah, 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 blah. Now, here's the great thing. Our questions, the questions that I developed in 1997, tweaked for 2 or 3 years after that, have been pretty solid then since 2001. Same questions over and over and over, and they work the exact same way. The exact same way. And so ask open-ended questions. Let them tell you. Do not tell. Do not sell. Do not preach. Do not teach. Let them do all the talking. Because we all know this. Great conversationalists do a lot of talking or a lot of listening. When you ask somebody, was that guy a good conversationalist or is that gal a good conversationalist? If they say yes, what do you know about them? That they did all the talking or that they did all the listening? If they said they were a great conversationalist, we know they did all the listening. So ask questions, and then after you ask questions, listen. Apply the 80-20 listening rule. I think it's the 95-5 rule. This is where you're only talking 20% of the time, mostly by continuing to ask questions and spending the rest of the time 80% listening. It's important that you be a proactive listener, as this skill will enable you to phrase questions in the moment and that are relative to what you're hearing. Nothing worse than pretending to listen and asking a question you prepared in advance that aren't relevant. More often than not, your fluent prospect is going to tell you that how to sell your services relative to the interest. And guys, this is all about us. Because our affluent prospect is going to tell us how to sell our services. Why? Because our affluent prospect is going to say their current guy is screwing them. That's what we do. And then the mini close. Essentially, the ability to mini close is what separates the not persistent and just persistent. What's mini close? Just what it appears to be. You suggest further discussion or assist financial related manner. So how do we do that? Here's our hard close, guys. You say, so today, did you learn things that you had not known before? Yes. And are there changes that you want to make, or you're satisfied with the current? No, there are changes we need to make. So where would you see me fitting in to that situation? Is it more of an academic exercise, or what would you want me to do? That's my close, guys. Then they have to what? They have to step over the chasm there and say, we want you to help us. We want to move our money to you. And then how do I close? And they say, okay, that makes sense, but let's do this. Have we covered a lot of information today? Well, yeah, we have. Yeah. So let's do this. Let's go to the front desk. Make an appointment for a week out. It'll give time for the dust to settle. It'll give you time to internalize some of the things we talked about today. It'll give you time to come up with some great questions. And we'll just get together next week, and we'll just move through this at your pace. How does that sound? That's my mini close. See, do I ever ask them, okay, let's do the paperwork? No. I let them say, let's do this. Does that make sense? So we want to be persistent, but in the right manner. So let's talk about that as it relates to one of the main topics, guys. And this is the climax of our book. If we're writing a novel, and the 21-point checklist is a novel, the risk reward is the climax of the novel. It's when all of the things we covered in the non-financial, where they said, no, you'd be a bad advisor. You'd be a bad advisor if you didn't cover this. You'd be a bad advisor if you didn't cover this. You'd be a bad advisor if you didn't cover this. Wait a minute. You're not my advisor. Wait a minute. My guy's the bad advisor. My guy's a bad advisor. My guy's a bad advisor. No, we never say that, but that's what goes on in their head as we cover all those non-financial things. And then we go into what? We go into titling. And the titling, then they say, oh, the company's a bad entity. Then we go into beneficiaries, and they say, wait, my guy doesn't really care about it. So he only cares about making money. And then we start going into, oh, wait, my guy actually did these things on purpose. And when we finally get to risk reward, it's like, holy crap, everything he put us in, he charges a huge amount of money for, when we could have gotten something even better at virtually no cost. So guys, if you're shopping and you find out you can get something for basically $100 with a lot more features, and then you go to the next place and they want to charge you $500 for a lot less features, what are you going to tell that? I mean, what are you going to think? How long are you going to stay in that store where they're charging you $500 for less features than the other store they're charging you $100 for a whole bunch of features? You're going to be angry. Those guys are trying to screw us. And that's where we get. So risk reward is when all of these things, from the non-financial to the company being bad, to my guy not caring, to my guy doing this on purpose, it all comes to climax here on risk versus reward. So What we don't want to do is go in too fast, though. If we go in too fast with that, what will they do? What's the knee-jerk reaction? They're going to pull back. Again, if you've done the whole meeting right and you get here, it's almost impossible to go too fast. But still, we've got time-tested, truly effective, works 96% of the time. Not because I say so, but because we've got hundreds, we've got almost 100,000 conversations have gone on over the last quarter of a century, 25 years. And if you compare the conversation from last year as compared to 2001, the conversations are identical, both from the advisor using the same questions and the client giving the same answers. Over and over and over, we've talked about this. If you ask the questions that are set up, the client will give you the same exact answer, even though they were developed a quarter of a century ago. So the first thing we have to understand, though, about risk reward is, what do most clients say when you say, hey, are you willing to take some risk? What do most clients say to that? Are you willing to take some risk? What do most clients say to that? Yeah, they all say yes, right? And when you do a risk reward test, those of you that do a risk reward test, how often do these people say they're pretty they're okay with risk? How often do they say that? Because when you sit down with somebody, how many clients do you find out have all their money in guaranteed versus all their money in growth or in stocks and bonds? Which, again, guys, stocks and bonds, is that a balanced portfolio? Are stocks and bonds a balanced portfolio? Everybody answer this, yay or nay, Y or N. Are stocks and bonds a balanced portfolio, yay or nay, yes or no? Thank you. Dale, Mark, Tom, yes, no, that is not. Can bonds go down? Yes, unless they hold until when? And when people are holding bonds, are they holding 1-year bonds, 2-year bonds, 3-year bonds? Or if their bond portfolio, they're in 10, 15, 20, 30-year bonds. That means unless they hold those bonds forever, until they mature, they are not guaranteed. They are not guaranteed. So that's not a balanced portfolio. Balanced portfolio is when you're in capital preservation. So capital preservation is annuities, it's in CDs, it's in money markets, short-term bonds, maybe a 1, 2, or 3-year bond, but it's not bond funds. Never bond funds, and certainly not a bond managed portfolio by a money manager, because they're not buying 1, 2, 3-year bonds. So here's the thing. We have to walk in, though, slowly, because most people think they can take a lot more risk than they can. Because here's the way they look at it. Now, guys, if we're at the playground and we see this, and I say, I'll pay you $1 million if you can walk on this balance beam. I'll pay you $1 million if you can walk on this balance beam. How many of you, give me Y's or N's? How many of you would say, yes, I'll do that? How many of you would say, yes, I do? I'd do it. Because what am I out? If I fail, what happens? If I fail, what happens? Nothing. So when your clients fill out a risk reward test and they say, oh, no, I'm not. Hey, if the market went down 20%, I'm okay with that. Really? How many of you had clients that are okay when the market falls 20%? Oh, yeah, it's okay. It'll come back. How many of you had clients like that? I never had clients with that. If the market fell 20%, they were what? They were worried. That's right, Andre. So when they take the test, it's like, oh, yeah, no, I'm okay. Saying that on a test is not experiencing it. So this balance beam in the playground, that's like taking the test. Oh, yeah, no, I'm okay with risk. Yeah, I'll do this. I'll do this for $1 million. Now, let me ask you a question. How many of you are going to do this for $1 million? How many are going to walk across this balance beam from this building to this building? And heck, this is even wider. This is even wider than this balance beam. How many of you want to cross between two buildings 30 stories tall for $1 million? I'm not. But this is actually, it's straight, it's not crooked, it's wider, it's not as narrow. So why wouldn't we do this? Because then the risk becomes what? There's no risk here. And taking a risk reward test, there's no risk. But actually experiencing a 20, 30, 40, or 50% loss, that's real risk. That's real risk. So we have to make sure that we're dealing with the risk reward appropriately, because I don't care what they say about risk. They're not okay with risk. I've never met a client that was okay with risk when it actually happened. Make sense? So when we're doing the risk reward scripts, we know that they don't want to be in risky things. But all we say is, you're taking a lot of risk, you're taking a lot of risk, you're taking a lot of risk. What's their knee-jerk reaction going to be? Oh, really? Oh, really? Because I've done what over the last decade? I've done really well over the last decade. I haven't seen my accounts go down very much. Why are you saying I'm taking a lot of risk? I'm fine. I haven't seen my accounts go down. Do they equate logically that, because the market hasn't gotten out. It's been since we haven't really seen a down market for a decade. Do they? And guys, if we haven't seen a down market for a decade, what's that tell us? That we're further away from a down market or closer to a down market? Yeah, we're closer to that. But they don't remember that. They don't even remember 2008. So we have to make sure that we don't tell them that they have a lot of risk, because I talk about the going to the ophthalmologist for your eye check. Does he say, when you say, hey, can you read those letters up there? No, I can't read them very well. Okay, so you try these pair of glasses. Can you see better? Oh yeah, now I can see better. Okay, well those are the ones you'll take. Go home. Is that how he prescribes glasses? No. What he does is say what? Okay, let's put on the little binoculars here. Click, click. Which one's better, first or second? Click, click. Which one's better, first or second? Click, click. What's better, first or second? Human beings are designed to what? Human beings are designed to what? Do comparison. That's what we're experts at. Side-by-side comparison. When you're buying a car, when you're buying a furnace, when you're buying any major purchase, what do? You compare side by side. And so what we want to do when it comes to risk reward is not say you're taking too much risk, just saying, hey, here's what you have now. Here's what you could have. Which one's better? Here's what you have now. Here's what you could have. Which one is better? Which one gives you a higher rate of return for the risk involved? Which one costs more? So would you rather have the one that gives you more risk, less return, or the one with less risk, more return? Oh, I want less risk, more return. Do you want the one that costs less or the one that costs more? I want the one that costs less. But right now you have what? The one that has taking more or less risk, we're taking more risk. And the one that you're paying more or less for, we're paying more for. So you're taking more risk and paying more when you could get less risk and pay less. Why do you think your advisor did this? And by this point, guys, how big a leap is it for them to attack their advisor? Not a leap at all. So that's how we're going to approach this, as comparing what they currently have with what they could have. So the whole script is, how does risk relate to return? We do the cable TV story. We review graph mechanics, how the graph on Morningstar works. Then we're going to use the talk about benchmark and what that means. Then we're going to talk about the no-cost investment line. Then we're going to talk about their money. So we don't even talk about their money until we've covered 1, 2, 3, 4, 5 steps before we even bring up their money. Then we ask, are fees good if you're getting something for them? Of course they are. So, but are you getting something for them? No. Then we say, so are you paying more or less, paying more or less return, or paying less to get a better return? I just kind of went through that. So why do you think this happens? So that's the script we're going to do. So the first thing we want to do is talk about, how does risk relate to return? So I'll ask people. So have you ever heard of the term risk reward? Sure, I've heard of that. So risk reward means what? If I take more risk, I get less return? Or is it if I'm willing to take more risk, I'm hoping to get a high return? Well, they're going to say, well, no, if you take more risk, you get a high return. How many people are going to get that wrong, guys? How many people are going to get that wrong? So when it comes to risk reward, if I'm willing to take more risk, I'm expecting what? A lower return or a higher return? Well, a higher return. So the more risk I take, the more what I want, the more return I want. And just like a CD, which is totally guaranteed, that I'm saying I don't want any risk. I want to be in a CD. Does that mean you're going to get a high return or a lower return? Well, a low return. Yeah. So risk reward is a measurement of what? Well, how much risk you take is how much return You expect. Exactly right. That's exactly right. So let's take a look at that today. So I've covered, have I done the how does risk relate to return then? Yeah. So the next thing I'm going to do is talk about the apartment cable TV story. So let me ask you a question. Let's say your daughter is going to go to rent her first apartment and she's kind of relying on you for advice. So the apartment that she's renting actually comes with cable TV. Cable TV. And they give her 100 channels of cable TV as part of the rent. Not a bad deal, right? And so that's a no-brainer. Okay, yeah, that's a good thing. But then she calls 2 weeks after she's renting now, she's in the apartment, and the cable TV company is called, hey, says, would you like to get cable TV? We'll give you 50 channels. We'll give you 50 channels for $80 a month. Guys, remember, the apartment, how many channels did she get for free with the apartment? 100 channels, no cost. So, and the cable TV company is offering what? Yeah, 50 channels, half as many channels for how much? For $80. So what are you going to tell your daughter? That she should go ahead and cancel the free 100 channel cable and pay $80 for half as many channels? Or should she tell the cable TV companies to jump in the lake? Now, what will 100% of the clients that you ask that question to say? What will 100% of the clients you ask that say? How many of them would say, well, no, I tell my daughter to throw the free thing away and pay $80 for half as much? Is anybody going to say that? No, they're not going to say that, are they, Andre? Now, the reason I'm starting with this is because when you start talking about money, people will say stupid things when it comes to money, especially if it's their money, because they don't want to look stupid. So again, as with all the scripts, remember we have a template. And the first part of the template is say, hey, what you're doing is good. Second part of the template is use a real world story. That, hey, the world works like this. And guys, does the world work this way? Where you want to pay the least and get the most. You want to pay the least and get the most. Does the world work that way? Would there be anybody in the world say, no, I'd rather pay more and get less? So when they agree to that, it becomes very difficult when we actually get to their money for them to say, no, there's when it comes to tires, when it comes to cars, when it comes to houses, when it comes to cable TV in an apartment, I want to pay less for more. But when it comes to my money, then I want to pay more and get less. Will they be able to say that without looking completely idiotic? And 100,000 tapes, when guys have followed this script, 100,000 and more, how many clients have said, no, I'd rather pay more and get less when it comes to their investment? I mean, 0 to 100,000, that's a pretty good batting average, right? It's just because this is a lot, it's human nature. So now, have I covered, or have I set up that nobody wants to, when it comes to real life, spend more and get less? Yes. And have I said it, or did I make them say it? They say it. And the best thing at the end of the cable TV series, so why? Why would you tell your daughter then to stick with the free one, the one that no cost? Because you'd be stupid. You'd be stupid. I mean, my daughter's not stupid, and I'm not stupid. It'd be stupid to get half the channels for $80 and then get it twice as many channels for free. Now that's them saying that. How easy is it for them to backtrack then? Very, very difficult. So now I've covered how does risk relate to return, and getting them to say with the apartment cable TV story that nobody wants to spend more and get less. Everybody wants to spend less and get more. So then we're going to review graph mechanics. Guys, you look at these graphs all day long. And first of all, our graphs difficult for many people. Our graphs difficult for many people to understand. In fact, I think the ACTs have a whole section on it. The whole science section in ACTs, I think, is reading graphs. A graph, easy or difficult for people to understand? Difficult. So I'm going to walk through this, have them walk through it to explain to me how the Morningstar graph works. Oops. Oh, and the benchmark and the no-cost investment line. And then finally, the investment analysis. So first thing I'm going to do is go back and get them to reiterate, because they've already said this with 10-year. They've already said this with fees. They've already said this several times, that the reason we use Morningstar is because Morningstar is what? Non-biased. So by this point, they've already, all I have to say, and remember, why do we use Morningstar? And they'll say what? Because it's non-biased. Yeah, exactly, non-biased. But I still have them say it in their own words, so they don't conveniently forget that Morningstar does not have some sort of agenda when it comes to giving us these numbers. So then I'm going to then show them the graph. I'm going to say, so this is a graph that's talking about risk versus reward. And guess why they call it? We know that because they call this what? What does it say right here? And again, I make them say it. Well, it says risk reward analysis. That's right. It says risk reward analysis. So what is this? What is this chart talking about? Well, they actually tell us in the four corners here. If you're in this corner, what does it say? And I make them say it. Guys, if I point to this and have them read it, how many of your clients have a high enough reading level to read low risk, high reward? They all can. So I make them read it. So if we're really close to here, it's saying they're taking how much risk? Low. And they're getting how much return? A lot. Right. If we go over here, it's saying they're taking what? Well, they're taking a high risk. And for that, if you take a high risk, you expect what? You expect a high return, high reward. Exactly. Now over here in the lower left-hand corner, they're saying a low what? Low risk. And a low what? Low reward. Yeah. And over here, it says high what? High risk. And what? Low reward. So it means if we take a low risk, low reward are going to be down here. And if we take a high risk, we expect a high reward. Where should we be? Well, you should be up here. Right. So does that make sense on how this chart is aligned? So guys, how many people, if I go through it like that, will understand this chart? Most or very, very few? And if you have a couple, what will there at least be one person in that couple that will understand this? Even if they have no exposure, whatever to finances, will they understand this? Going through it, again, making them read this. If they don't understand it, will I know they don't understand it? This is a good question for you to answer. If they don't understand it, will I realize right now that they don't understand it? Yes. Why will I understand they don't understand it? Because it would be answering my questions, what? Wrong. So then I would have to, should I move forward? No, then I have to circle back and ask even easier questions. Circle back and ask, but that's going to happen 1% of the time. 99% of the time, they're going to get it. So then my next thing I have to cover is this S&P 500 benchmark. Let me say, have you ever heard of the term benchmark? It's kind of a fancy schmancy term, but have you ever heard of the term benchmark? Many people will say yes, and I'll say, what does that mean, a benchmark? And I'll have them say, if they don't understand it, well, I'll say what a benchmark is it's something that you compare things to. So benchmark would be the middle of the road, and then what you're going to do, you're going to use that as the benchmark, you use that as the starting point, and then you're going to look at it as something better or worse than the benchmark, more expensive or less expensive than the benchmark. You're going to ask, you're going to see, is it better or worse than the benchmark? So that when it comes to stocks, they use the S&P 500. Have you ever heard of the S&P 500? Yeah, I've heard of it. Do you have any inkling of what that is? Well, I think it's like 500 stocks, right? Yeah, it's 500 stocks. And do you think they're the smallest stocks, or do you think they're the biggest stocks in the economy? Well, I would assume they're biggest. You got it. They're the 500 biggest companies in the country. So why when we listen to the news and we listen to financial markets, do they always talk about the S&P 500? Because do all of us invest in the S&P 500? Well, no. Yeah, everybody has all sorts of different investments, right? But why do they tell us the S&P 500? Well, I suppose because it's like a benchmark. I say, yeah, it's like a benchmark. So we know, are we doing better or are we doing worse than S&P 500? They also mentioned the NASDAQ. We're going to talk about that here in a second, because that's also a benchmark. So do you understand? So what this black box here, that's the S&P 500 saying, hey, this is what you would do if you were just in the 500 biggest stocks. Just in the 500 biggest stocks. And the funny thing is, to be in the 500 biggest stocks, guess how much that costs you to buy the 500 biggest stocks? Guess how much of a sales charge Guess how much of a fee? We talked about fees earlier, right? We talked about sales charges earlier. And were you paying a little or were you paying a lot? No, we were paying a lot. Yeah, you're paying what, $1,000 or $7,000? No, we were paying $7,000. Yeah, and in my world, I don't know where you live, but $7,000 is what? Well, that's a lot of money. Yeah. Now, the funny thing is, guess how much it costs to be in the S&P 500? And guys, how much does it cost to be in the S&P 500? How much does it cost to be in the S&P 500? Virtually nothing. Yeah, so this is the benchmark that they use, and it costs nothing to be in that. Now, the thing is, that's the biggest 500 companies out there. And can those biggest 500 companies go up and down in value? Well, yeah. Isn't that why every night they tell us, hey, the S&P 500 did what? Well, it went up or down. Yeah, it went up or down. So we know it can go up or down. So does it have some level of risk then? Well, yeah, of course it does. Of course it does. So if we take less risk, remember we said right down here, if we take less risk, we're looking at what? Yeah, a lower return. Lower return. So what would be an example of a lower risk thing? Now, if they say a bond, what do you know? If they say a bond, what do you know? Did you do the 21-point checklist right? If they say a bond, because remember, this is well beyond the fee portion, the interest rate volatility portion, etc. If they say bond, you know you did it what? You didn't do the interest rate portion correctly, because they should realize that bonds are not a safe investment. And guys, can bonds lose as much as stocks? Can bonds lose as much as stocks? Heck yeah. When I sold bonds at the Norwest Bank or at Wells Fargo, I had bonds lose 30% in a month back in the late 90s. So bonds can lose as much as stocks. So if they say bonds, you know that they're wrong, that you were wrong when you covered the interest volatility. So instead, you want to maybe, yeah, that's right, Mark. Mark is saying minus 29% in 2022 on a 30-year. That's exactly right. That's minus 29% is not a guaranteed investment, guys. So back into role play here, I'm going to say, yeah, so obviously there are things that take less risk than stocks. I mean, one example would be at the bank. And what do they have at the bank? I'm going to front load this question. So what investments do they have at the bank that would have less risk? Well, anything that has FDIC insurance. Yeah, FDIC insurance. So what are some examples of that? Well, like a checking account and a savings account. Yeah, checking account, savings account. And then they also have what, if you put it in for a certain period of time, what are those? Those are CDs. Yeah. And do we make the same kind of money on a CD or a bank account or savings account as we do on the stock market? Well, no. Yeah, no. You're exactly right. No. So we take a lower risk and lower return. So what are CDs going for? Do you know what CDs are paying right now? And they'll say whatever that is in today's world is what, maybe 4%. So yeah, so it's 4%. So we don't have 4%. We're going to draw a line from here over here to 4% because the less risk you take, the less return you get. So we got 4% here. We're going to draw a line to here because again, the less risk we take, the less return we expect. Now, on the other hand, do you think if the S&P 500 are large companies, the biggest 500 companies, are there smaller companies out there? Well, yeah, sure. There's tons of stuff. Yeah. And if you're looking for the next big stock, is that going to be more risky or less risky? It would be probably more risky, right? Because we don't know what the next. You're going to take have to take a risk that I might not be right, but I might be right. And boy, it'd be nice if I could find that needle in a haystack that blew up and made me all sorts of money. If that's what I'm looking for, am I taking more or less risk? I'm taking more. Yeah. And there are stocks out there like that. So what that's saying is if I'm looking for a higher reward, though, I have to be willing to accept what? Yeah, higher return. Yeah, so when I draw this line, I'm going to start at guaranteed, FDIC guaranteed, go through the S&P 500, which is the benchmark for stocks in general. But if I take more and more risk, buy more and more risky stocks, hoping that I find that needle in the haystack, I'm taking more and more what? Risk to get hopefully a higher return. And even then, there's benchmarks. Remember we said earlier that the NASDAQ is also something you hear in the nightly news and the financial news? Do you know what the NASDAQ is? Wasn't that more like tech stocks? Well, yeah, the tech stocks are a big part of it. So you're absolutely right. Tech stocks are a big part of the NASDAQ. And the reason for that is because it's a rather new type of industry. So not only is it tech stocks with any newer, smaller companies, not any, but most smaller, newer companies going to be in the NASDAQ. So are we taking more or less risk when we're buying those smaller companies and looking to hit a home run with them? We're taking more. The funny thing is, though, if you invest in the NASDAQ, just like the S&P 500, it's a certain number of stocks, and it's called a exchange traded fund, or it's called an index, which means that there's no manager managing that. Just if you look at somebody who says, I'm investing in the NASDAQ, everybody that's invested in NASDAQ will have the exact same stocks in their portfolio. Investment A would have it, investment B would have it, investment C would have it, because if they say they're invested in the NASDAQ, it is a certain bunch of stocks, and everybody will have the same stocks. That's why it's called an index. Like with the S&P 500, it's 500 of the biggest companies. NASDAQ has an index of more aggressive, hopefully higher return companies that are indexed. And you can buy that. Guys, how much does it cost to be in the NASDAQ? Because if there's no manager managing that fund, it's just a bunch of stocks, and everybody owns the same amount or the same exact stocks in the NASDAQ. And you could look it up. You can go on Google, say, what stocks are in the NASDAQ, and it would give you those stocks. That means if you can Google it, how much does it cost you to Google that? Well, nothing. So how much do you need to pay a manager then to buy the NASDAQ stocks for you? Well, guys, how much? How much do you need to pay a manager to buy the NASDAQ stocks for you? A lot, or basically pennies? Virtually nothing. Yeah, so the NASDAQ could be up here somewhere. So we go from no risk, a low return, to the S&P 500 to what? High risk, high return. And then when we connect these, so how much does it cost to be in a CD? How much does it cost to be in a CD, guys? How much does the bank charge you to be in a CD? Nothing. How much do they charge you to be in S&P 500? Nothing. How much did they charge you to be we talked about if there's no management in the NASDAQ, how much do they charge you to be in the NASDAQ? Nothing. So I call this line my no-cost line, because you can be in a CD at no cost, you can be in the S&P 500 at no cost, and you can be in the NASDAQ at what? The client will say what? No cost, right. So why do I call this my no-cost line? Because it doesn't cost you anything to be on this line. It doesn't cost me anything to be on this line, yeah. So just like when I was in the apartment, or my daughter was in the apartment, this would be the equivalent to what? The apartment saying you get 100 channels at what cost again? What, no cost. And when the cable TV company called and said, hey, how's it like half as many channels at $80 a month? We told my daughter to what? Yeah, it tells the cable company to jump in the lake. Why? Because all the cable company TV is trying to do is what? Make money on it, right? So she'd be getting more or less? She'd be getting less. And she's paying more or less for that? Paying more for that. So she doesn't want to pay more for less. She wants to pay less for what? For more. Yeah. Now the reason I bring this up, again, this is what do we call this line again? Well, the no-cost investment line. Right, no-cost investment line. So you see all these little dots here. These dots correlate. Do these sound familiar? The Dreyfus Opportunistic Value, the Goldman Sachs Emerging Markets, the Guggenheim High. Do these sound familiar? Yeah, they're our funds. Yeah, they're your funds. So where your funds are showing up here, this is where your funds are showing up. So it's saying that on this fund number 4, Guggenheim Mid Cap, it's saying you're taking this much risk to get this much return on average over the last 3 years. This much risk is this much return. Is that above or below the no-cost line? Well, it's below. How about number 1 here? You're taking this much risk to get this much return. That return's not bad, right? That return's not bad at all. That's pretty darn good. But we could have been where? Yeah, up here at the same for the same return. I could have been taking I'm sorry, I could have been taking a lot less or got a lot more return for the same amount of risk. I'm sorry, this is the risk. Guys, I screwed this up. Should I have covered, when I covered the 4 corners here, should I have covered that going from left to right means taking more and more risk? I screwed that up. See how that's biting me in the butt? I mean, is it fixable with a client? So right here, this is called standard deviation, which is risk. So the more risk I take, am I going left or right here? I'm going right. And this is return. The more return I'm getting, I go down, or do I go up? I go up in return. So with number one here, you would have been what? I could have got how much higher. So it's 14. Which one's better, 14 or 4? 14 or 4? Which one's better in rates of return? Well, 14 is. So this is taking the same amount of risk, but getting how much return? Well, much less return. How about number 7? Could have been getting, instead of 10%, which is not a bad rate of return. 7 is not a bad rate of return. We could have gotten what? 14. So would you rather get double the rate of return? And it's for the same amount of risk? Look at this one, number 6 here, Prudential Genesis Natural Resources. Where is that? You've averaged negative 3.6% a year. For that kind of risk, you could have been making what? 22%. So instead of losing money, you could have been making 22% a year. So where does this put you? Sorry for that, guys. I forgot major. That's where you want to do this so you can't get it right. You don't want to do this so you can't get it right. You want to do it so you can't get it wrong. So guys, folks, what did we say this line was? Well, the net cost zero line. The cost zero line, yeah. So how much did we say you're paying for all of your funds? Over $7,000. So you're paying over $7,000, and how much return are you getting for the risk you're taking? Well, less. A little less or a lot less return? I mean, 4% versus 14, 7% versus 14, 11% versus 17. You're getting a lot less return or a little less return? A lot less return. And again, we said investing in the S&P 500, investing in a NASDAQ would cost you how much? Over nothing. So instead of paying $7,000, you'd be paying what? Well, $0. Hey guys, or Mr. and Mrs. Smith, I'm okay with you paying fees. I'm way okay with paying fees. But when I pay fees, I expect to what? Get something. Get something. I want to expect it. Yes. So when I go to stay at the Four Seasons, does that cost more or less than the Motel 6? Will cost way more. Cost way more. And I don't mind that if I'm what? Well, if I'm getting something for it. Yeah. But if I'm getting Motel 6 beds and Motel 6 crappy swimming pool that's dirty and they don't pick up the towels, and Motel 6 crappy concierge, and I'm paying Four Seasons prices, I'm going to be what? Well, angry. Angry. So right now, right here, the no cost line would have given you a better or a worse rate of return? Or better. By a little or by a lot? By a lot. So you're taking far more risk and getting what? Much less return. And you're doing what? Well, we're paying for it. And you're paying how much again? $7,000 a year. $7,000 a year. $7,000 a year. So guys, do you see why this is the climax of the 21 Point Strategy? Can you paint a picture any more clearly than this, that their guy is basically, guys, can anybody make this mistake? Can an advisor make this mistake? Or is this telling you that why didn't an advisor get them into the indexes? Why didn't he? Why didn't he? Because he couldn't make any money on them. So we go into the investment analysis, then I'm saying, so these are good if you get something for them. That's the analogy of the Four Seasons versus Motel 6. But are you paying more for less return? Are you paying more for less return? Or are you paying less for more return here? No, I'm paying less for more return. Yeah, and if you had it, do you want to pay more and get less? Or do you want to pay less and get more? Well, we want to pay less and get more. But instead, you're what? We're paying more and getting what? Less. And are you paying a little more? I mean, what's in between paying nothing and paying $7,000? Paying nothing and paying $7,000. Is that a little more or a lot more? No, we're paying a lot more. And the return, well, you could have got a 7 instead of you got a 7 instead of a 14, or you got a 10 instead of a 16. Is that a little or getting a lot less? A lot less. So why then? So why? Why do you think this happened? And guys, if at this point they're not pissed off, it's what reasonable person, again, remember, we're about an hour and a half into the meeting at this point. And the first part of that whole an hour and a half was about them discovering slowly, then more, that their guy is taking advantage of them. At this point, can we paint a clearer picture of the risk reward? This is where I saw people get pissed off. Usually the wife would get pissed off at the beneficiaries, but at this point, even the guy who used to love his advisor is thinking, what is a guy who golfed with their advisor, who went and had a happy hour with their advisor, who always talked about the football game with their advisor, because he's my friend. He's my friend. Of course he wants to golf with me. He's my friend. He wants to go to happy hour with me. He's my friend. He wants to talk football with me. What is he thinking about that friend at this point? Is he really a friend? Is he really a friend? And that's why I say, guys, when the more they tell me they love their guy at the first meeting, the more I salivate. The more most advisors, when they hear, oh gosh, he really already loves their advisor, they've been with him for 12 years. Oh, they go to they go on vacations together. Oh, geez, there's no way I'm going to get this guy. I don't think that. I'm thinking, awesome, because the more they love their guy, in the end, at this point, the more they what? The more they love their guy. See, here's the thing. If somebody's a jerk to me on the street, I think he's a jerk. But do I know there's jerks on the street? Am I totally offended? Now, jerk. So I don't know that guy. But when the guy I thought was my best friend, I find out is a jerk, how much does that affect me emotionally? Just some stranger on the street being a jerk versus my friend being a jerk. Which one affects me more emotionally? My friend. And by a little or by a lot? By a lot. So I don't panic. I do not panic when they tell me that they love their guy at the first meeting. I don't do it in front of them, but in my head, I just dance a little jig saying, oh, this is so awesome. They love their guy. Because I know this is going to work so effectively, because they're going to figure out for themselves that guy wasn't treating them great because he liked them. Why was that guy treating him great? Why was he golfing with them? Why was he going to a happy hour with that guy? Why was he being buddy about taking him to a football game? Why? Because he really liked the guy? No, the cost of doing business. I have to keep him happy so I can make a ton of money off of him. That's why. Do you see why this is the climax of the meeting, guys? And again, I apologize for goofing up that. You have to explain the whole graph, not just the four corners, but then make sure they understand the further I go this way, the more risk I'm taking. The further I go this way, the higher return I'm getting. But do you get by covering the cable TV story first, how many people are going to argue with you once they realize that this is where their stocks, this is where their funds, this is where their money manager shows up? How many people are going to argue with you? What percentage of people are going to argue with you at this point? I got one answer. Come on, guys, I need more answer. What percentage of people are going to argue? Again, it just said that they would never, ever allow their daughter to spend more to get less. Are they going to say, but it's okay for me to spend $7,000 a year to get less return that I could have gotten? And guys, is this a little less or a lot less? It's a lot less. Does that make sense? Cool. So we've now come up with the motivation. And remember, guys, with all these parts, starting with fees, interest rate volatility, interest investment rating, manager tenure, turnover cost, preferred list, and risk reward, at the end, to get to the motive, we always say, so, do you want to pay more to get less, or do you want to pay less to get more? No, I want to pay less to get more. And right now, you're doing what? Well, we're paying more. And you're getting what? Less. So that goes for fees, goes for interest rate volatility, investment weighting, manager tenure. We do that at the end of every single one, because does this paint a very clear picture of motivation of why the guy did it? Sure it does. That's what we do. We do the same conversation here, 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 same conversation here. We end each one of these with this conversation because in all cases, are they paying more and getting less, or are they paying less and getting more? In all cases, they're paying more to get less. If you say that 1, 2, 3, 4, 5, 6, 7 times about your advisor, do you trust your advisor? How badly do you want to get rid of your advisor? Are you going to wait till after vacation? Are you going to wait till the market comes up? Are you going to wait till the market comes down? Are you going to wait till after Christmas? When, guys, if all these 1, 2, 3, 4, 5, 6, 7 times I say, I'm paying more and getting less instead of paying less and getting more, if I say that 7 times, what's the likelihood I'm firing my advisor right then and there? It should be what percentage? It better be 100%. If it's not, even though I'm retired, I'd be very happy to listen to the tape. And am I going to find that you did it all right? If at this point they don't want to get rid of their guy right now, what's the likelihood I'm going to find out that you did things right, did the scripts right? And guys, as you just seen, I make mistakes on the script. So what do you make when you make a mistake and it didn't go right? What do? Throw up your arms? No. You do what? Go back to the drawing board, sharpen your skills again, sharpen that knife again, and go back and do a better job the next time. Does that make sense? Cool. So Allie asked me to talk about secure your spot for the 5Q weekly coaching call in advance. Get ready for new topics and fresh schedules to help finish the year strong. So new schedule updates, updated dates, times for December call. Stay tuned. We'll be getting those hopefully a little bit in a day or two. Key areas of growth, leadership, personal development for the holiday season. End of year planning strategy to set up yourself up for success in the new year. So go to the 5Q website under the coaching call topics and schedule, or you can go to linkedin.com right here. And I think, Allie, if you don't know any of the guys there at 5Q can help you out and find this. Make sense? So remember, we're now in the holiday season. Be working on your skills. Get better at using those crib notes to do the things that we talked about. Your daily practice of the myths and the gods. Do your 5-minute, 5-minute moneymaker. Find that 5 minutes before every single meeting you have to get yourself focused on what you're going to cover at that meeting. When you do that, you're going to bring on every single client. Okay? Hopefully, was this a good call for you? Yay or nay? Was this a good call? I know I get excited and get a little bit loud about these things, but my goodness, guys, I want you to understand this is you have the world is your oyster. You have these scripts. Please use them. Make sense? Super duper. You guys have a great rest of the day and a great rest of the week. Talk to you soon. All right. Bye-bye.